All right, we have more changes unfolding in the U.S. economy and over at the Federal Reserve. Changes that have a hawkish Jerome Powell coming out at yesterday's FOMC meeting, taking a March rate cut off the table and pissing a lot of people off in the process. They always manage to do this somehow too. They always manage to hoodwink markets at the end of the year, manipulating bond markets, especially this past November and December, that cuts were coming. So much so that the 10-year fell over 100 basis points since October, which we're going to look at in this video because there's a whole lot happening there that meets the eye. What was the point of all that? Well, we'll explain. Also, for all of you who think that the Fed can't cut yet, that prices haven't fallen yet, and inflation's still too high, well, not according to Janet Yellen. We have a clip of her from last week where she makes some stunning admissions as to the Fed's real goal with all this. But before we get started, thank you for liking and sharing these videos. It really helps me out. Also, make sure to subscribe to the channel so you don't miss these regular updates. So the Fed, they just wrapped up their January FOMC meeting where all the Fed governors and presidents get together behind closed doors to discuss the future of monetary policy in this country, and notably if they should decide to cut, pause, or hike the federal funds rate, the overnight rate. Well, they decided to pause again, which was expected, but what wasn't expected was seeing Jerome Powell come out in such a hawkish manner, not even mention QT. We're going to get to that. But also taking a March rate cut basically off the table, something that markets had been betting we'd see for months now. The markets priced in the first rate cut coming in March. We'll take a look at the betting markets today. March is now priced out. Instead, a 65% chance we'll see the first cut come now in May. And likewise, an additional cut for every other FOMC meeting this year, totaling a whopping 150 basis points in cuts by December 2024. Now, that's a bit more extreme than what Goldman Sachs is projecting. They forecast only 100 basis points in cuts, but it doesn't really matter. When Jerome Powell can manipulate the bond market this easily, realize he came out in November and December and convinced almost everyone that rate cuts were imminent. So much so that we saw the 10-year fall over 100 basis points since October. We've seen the 30-year fixed rate mortgage fall 150 basis points. And why? Well, if you watch our videos regularly, we had speculated that all of that was just a show, a way to give the massive number of businesses and real estate investors who have loans resetting. Look, we're set to see 4x the number of corporate loans reset in 2024 than we did last year. Many of them in the first half of the year. What I had said was that maybe he's trying to give them some breathing room. 150 basis points is a huge difference when your loan rolls over. If you have a commercial loan at, say, 4% and it matures this month and your new rate is, who knows, like 8 or 9%, that's a major jump, something a lot of businesses have been warning they won't be able to survive. Well, after Jay Powell's miraculous performance in November and December, he was able to convince investors to lock in these higher rates. Bond traders jumped into action and yields fell bigly, down enough to where you won't be looking at 8 or 9% anymore. Instead, maybe 6 or 7%. May not sound like a lot, but it is. It's a big difference. 1 or 2 points can mean the difference between staying in business or closing shop. So anyways, that's what, I thought he may be doing, but instead it turns out none of this was for small and mid-sized businesses. It turns out it was all for the banks. The banks were the ones who were warning the Fed behind closed doors that yields were just too high. They had too many floating rate loans on their books that were coming due, are still coming due, and they worried they see too many losses, too many defaults, that the system was at risk. Just like unbelievable. Yesterday, for instance, NYCB, New York Community Bank, saw their market cap plummet after reporting earnings. Look at this, dropping back to where it was when the banking crisis was unfolding last year. They announced they'll be cutting their dividend after taking larger than expected losses. And what happened? What was the cause? The reason they saw such large losses, bad loans, folks, just 2 loans apparently that they were carrying on their books caused them to end the quarter with massive losses, ending Q4 with a whopping $252 million loss in the fourth quarter. So this is what happens. This is what can happen when big loans go bad, folks. When the borrower can't afford to pay, it can have massive ripple effects throughout the entire system. And this is just one bank, right, who lost $252 million in a single quarter. After having a profitable Q3, they went from earning $207 million in Q3 to losing $252 million the next quarter. Here's Jerome Powell yesterday explain the FOMC's decision. Watch this.
Inflation has eased from its highs without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. I want to assure the American people that we are fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Over the past 2 years, we have significantly tightened the stance of monetary policy. Our strong actions have moved our policy rate well into restrictive territory, and we've been seeing the effects on economic activity and inflation.
So they're pausing, and they're fully committed to returning price stability down to their 2% goal. They always say that, but they're continuing to reduce their security holdings. No mention of QT ending. That's a surprise. All the big investment banks were forecasting the Fed would announce some plan for ending quantitative tightening, even if they just announced they're beginning to formulate a plan or something like that to do so, but nothing. He said no plan for QT. Continuing like normal, continuing to reduce security holdings. If we jump into Snapforce, we could see both B of A and Deutsche Bank. It said that QT was coming to an end. You could see here Michael Arnett, B of A's flows guru, wrote this on Friday. Michael Arnett's Friday note, he harped on the coming end of quantitative tightening since October 2023. Global central bank liquidity has risen, not fallen, and the Fed is expected to end their tightening campaign in the coming months. He wrote, big picture, 2022-2023's quantitative tightening ending, and in Q4, central bank liquidity flipping to Wall Street positive. We also have Deutsche Bank writing this, quote, with officials recently sending mixed signals about the urgency to slow QT, we will look for Powell to provide an update on any discussions. While we believe it's still too early for officials to agree on a revised set of balance sheet plans, an update to this guidance is likely to arrive at coming meetings, unquote. Now, for everyone who thinks this is good, by the way, that the Fed's doing their job, prices are still too high, the housing market's still too high, rents are too high, home prices, food prices, everything's too high. So we want the Fed, to keep doing what they're doing. We want some deflation here. Now, I personally believe we could use some deflation, even though, it's not normally a good thing. When you look at prices today versus 3 years ago, prices are just so much higher. Almost everything is higher today, remarkably higher. Prices can rise only if wages rise along with it. But in 2021, we saw this massive jump in prices, completely outpacing wages. So when you hear people say there's no inflation, they got inflation back down, they're missing the point. Prices never fell. The rate of price gains may have fallen, but prices haven't fallen themselves yet. Well, take a listen to Janet Yellen last week. In an interview with ABC, she was asked this question, what do you say to Americans who don't see prices falling enough? How prices still haven't fallen back to where they were pre-pandemic? Listen to her response. Watch this.
How do you convince Americans and voters that those prices might not go back to where they were before the pandemic?
Well, I think most Americans know that prices are not likely to fall. It's not the Fed's objective to try to push the level of prices back to where they were.
It's not the Fed's objective to push prices down, she says. And look, she's right, technically. Fed cares about one thing, their mandate, getting inflation to 2%, which means seeing prices rise 2% compared to where they were 12 months ago. There's a big difference between that and deflation. But what I think is happening here is these people give off this false sense of control, right? Like they feel like they're in control. Jerome Powell playing with the market like he did these past few months, manipulating the bond market to artificially lower yields to front run more banking turmoil. They feel like they can do all that without any consequences. But what I imagine they're going to learn eventually at some point is that they aren't in control here and things are getting much worse than they seem to realize. Maybe they do realize it. The labor market, for instance, in the gutter, when you look at unemployment numbers by state, instead of nationally, you'll find 85% of states are seeing rising unemployment. Quits are now just as high as they were pre-pandemic. I don't know what it is, but there's something funky about this federal data. The BLS data is just wonky. I know some of you think it's got to do with it being the election year. I don't know. 3% unemployment, though, still. Is it all the asylum holders working legally all of a sudden? 3 million plus illegal migrants claiming asylum and entering the workforce this year? Is that artificially boosting the jobs data? I don't know. But I do think the Fed will end up being forced to cut rates sooner than later. They may not want to, but they're going to need to. Just my opinion. All right, that wraps up this episode. Like, subscribe, and we'll see you next time.